Do you want to know how to buy a home with little to no money down? In this video, I'm going to walk you through what your options are, the pros and cons for each, and how they can help you buy your first home. And stick around to the end because I'm also going to give you 3 additional tips that you can do right now to make owning a home a reality. Let's get into it. We've all seen how crazy the housing market's been over the past few years. Historically low rates caused an absolute buying frenzy, which drove up prices, and now, ironically, those same historically low rates are causing a shortage of inventory. And I'm here to tell you that it's not. Conventional options come into play to offer some wiggle room to buyers that maybe don't have that traditional 20% to put down, but are ready to make that jump from burning money on rent to creating everlasting wealth with home ownership. The old assumption that you have to put down 20% in order to buy a home is just that, an old assumption. While it's a great way to avoid PMI, which stands for private mortgage insurance, and is added to loans that do put down less than 20% in order to protect the lender in case of buyer default, it's not necessary. And in most cases, you can put down as little as 3%, and in some cases, 0. Let's get into them. First up is probably the most popular and definitely the most common, which is the standard FHA loan from the Federal Housing Administration. These loans let you put down as little as 3.5%. They tend to have lower credit requirements and are government insured, which makes them very popular amongst first-time home buyers. However, they do counter these with stricter guidelines, especially dealing with HOAs and limits on how much you can borrow. However, one good thing about these is if you wanted to buy a 1 to 4 unit or small multifamily, they do allow it. You just have to make one of the units your primary residence, and there are some additional requirements as far as rental income on the additional units. Next up are VA loans from the Department of Veterans Affairs. Now, this is the first loan product where putting down 0% is actually an option, in addition to no mortgage insurance. However, anything less than 10% down will result in a small funding fee, but you can actually roll this into the loan. Another rule for VA loans is it can only be used on your primary residence, and you can only have one active at a time. So if you use one to buy your first house, in order to buy another house, you would have to either refinance out of that or sell that to get another VA loan on your next home. Similar to FHA, it's pretty similar rules when it comes to the 1 to 4 units. As long as you occupy 1, up to 4 units is an option. These loans do tend to have lower rates than most other programs. However, they are exclusively for eligible veterans, active duty service members, and some surviving spouses. Another potential zero-down option are USDA loans from the United States Department of Agriculture. USDA loans are a great option for buyers in more rural areas. And I know this sparks visions of you starting your life in the middle of nowhere as a corn farmer or something, but that is not the case. Their definition of rural is much more loose than you may think, and a lot of suburbs actually qualify for this loan type. Much like the first 2 options, USDA loans are also government insured, which means they tend to have lower interest rates, and they actually let you roll all your fees and closing costs into the loan. Now for some of the restrictions on this loan, and the biggest being geographically. If you're looking to live in the heart of a downtown area, well, this loan isn't going to work for you. However, if the thought of living outside the city sounds like a good choice to you, this can be a great no money down option. They do have limits on income when qualifying, as this program aims to help low to medium income home buyers achieve home ownership. That being said, unlike the previous 2 options, USDA loans are for primary residences only and don't allow for 1 to 4 units. Also, they do tend to take a little bit longer than your average program, so do keep that in mind when purchasing. Now let's get into the conventional 97 loan. The conventional 97 loan is pretty much exactly what it sounds like. It's a conventional loan product where you put down 3% and you borrow 97. This is a standard fixed rate loan, so your payments will remain the same throughout the duration of the loan unless you refinance. These loans do not have income limits and tend to have higher loan limits, which gives you the flexibility on how much you can borrow. Entry credit score for these are 620, but the higher the score, the more favorable your rate. Now, with only putting down 3%, you will have the additional payment of PMI or private mortgage insurance, which we discussed earlier, until you hit that threshold of 20% equity. But it does allow you to buy sooner and start building that equity, so it may be worth considering. Lastly, at least one buyer on the loan must be a first-time buyer, and again, this is aimed at purchasing a primary residence. Another great option is state and local assistance programs. Many states and local governments will offer assistance programs aimed at first-time home buyers. For instance, CalHFA has a number of programs, including My Home, which will loan you the 3.5% down so you can buy your first home, as well as the recently renewed Dream for All program. Well, they'll actually give you the full 20% down to buy a home in exchange for shared appreciation on the sale. Next up is Fannie Mae's Home Ready and Freddie Mac's Home Possible. These programs are pretty similar as they both allow you to put down as little as 3% and do both require you to take a home buyer education course, which is free. Since these programs are aimed at low to moderate income home buyers, they have great flexible down payment options. But what really sets them apart is what they call border income. Border income is defined as any room, rooms, or space in a home that adds to additional revenue. So that good friend that said they needed a crash in your spare room for 2 weeks and they've been there for 6 months, yeah, you can count that as income. Pretty cool, right? Now for 3 additional bonus hacks, in addition to loan programs that can help you achieve homeownership this year. Our first creative tip is to consider a co-ownership model. Prospective buyers can partner with friends, family members, or investors to pool resources and share financial responsibilities of owning a home. This not only reduces individual burden, but also opens up more housing options that might otherwise be unaffordable. Creative tip number 2. Gift funds are another great creative option. Many lenders allow a portion or even the entirety of a down payment to be gifted. Gifts, however, must come from relatives, including spouses, partners, children, individuals related by blood, marriage, adoption, or even guardianship. Lastly, tapping into individual retirement accounts like IRAs or 401ks provide quick access to cash. However, this should be discussed with your lender or accountant as it can affect long-term retirement plans and may result in penalties or taxes. From the capital appreciation to the tax benefits of owning a home, I hope this was helpful and encouraging. As always, I'm ready to help answer any additional questions you may have, so feel free to schedule a one-on-one call with me in the link below, and I'll see you next week with more real estate tips.